Okay, folks, so in this lecture, I'm just going to give you an overview of accounting so that you can develop a financial plan for funding purposes. And the best way that I like to do this is I like to go ahead and pretend that I'm starting my own business. So let's say that I'm going into business, I'm starting a clown college because clowning around is my business. So my first step is listing out all of the costs that I know I'm going to incur, whether that's stuff that I need to purchase, stuff I need to lease, other stuff I need to buy, whatever it might be, prior to opening my business. So I know I'm going to need a clown car for my clowns. I might need a computer. I'm going to need some kind of smartphone. I might have to rent an office that has some classroom space. I need a website. I'm going to need some clown supplies, so some stilts, some makeup, some props. I need some clown suits, and I'm going to need a business license and a fictitious business name. So our next step is to record the startup cost for each item, and this is going to require some research on your part. You're going to have to track down pricing and be as accurate as you possibly can be. So I've listed out my costs for my startup. I think they're relatively accurate. I'm going to find some used stuff. I'm going to spend a little less on the clown car so I can buy a little bit of a nicer laptop, maybe a MacBook, whatever it happens to be. So I've recorded all of my costs, and my next step is going to be step 3, which is to classify those costs. And classifying costs is really about speaking in the language of accounting. So assets are items that you own. So for example, cash, accounts receivables, cars, computers, anything that you can sell when your money runs short in order to put back into the business is what we would call an asset. In fact, that's the asset test. If you can take an item and sell it and put that money back in your business, then that is an asset. Liabilities, on the other hand, are long and short-term loans that you owe. So some examples might be a car loan, an account payable, and the trick for a liability, or the tip for a liability, is a liability is always going to offset an asset. So if I have a car, for example, I might have a loan out on that car. If I took a loan out from some friends to start the business and I bought some assets, those with that money, those assets are going to offset that loan. Expenses are costs you incur in the course of doing business. So your rent, your utilities, any sales-related costs, licenses, wages to employees. You know something is an expense if you have to pay it regardless of how much business that you do. They're referred to a lot of times as sunk costs because they're costs that go into the business and don't necessarily come back out. If you think about your rent, you have to pay the same level of rent regardless of whether you have one customer or 1,000 customers. So that's an example of an expense. Your revenues are another word for sales. Capital is the money that you invest in the business. So if you take $500 of your personal savings and put that in the business, then that's capital. Drawing is money that you pay yourself. So when you take money out of the business as a sole proprietor, that's actually referred to as a draw. That represents a decrease in capital. If you're incorporated, you would take the money out as dividends, or you might perhaps pay yourself a wage. And then finally, retained earnings is profit that is kept by the business, which means that it's profit that's not paid out to investors or shareholders in the form of dividends. So my next step is to go ahead and classify those costs. So my clown car and my laptop, those are assets. My smartphone, that's going to be another asset. Again, the test, can I sell it and put the money back in the business? Yes, I can. My office rent, that's going to be an expense. Same with my website. Same with my clown supplies, stilts, makeups, prop. It's $500, and technically the stilts and props I could probably put back in the business, but I think it makes sense to me to treat that like an expense, and I'll talk about that one in just a second. Clown suits, I'm going to spend a lot on those. Those are $2,500, so those are assets. Business license and my fictitious business name are also examples of expenses. And so what happens when you are are costing out all of these items for your businesses, you're going to find that you have a lot of assets that don't cost you very much money. And a lot of times it's easier just for accounting purposes, if you have that stuff, is to set a level and treat any asset below that or cost below that as an expense. So I'm going to set my level at $500, which means that any asset that costs less than $500, like my smartphone, for example, I'm going to treat like an expense. So that's where, so I've got everything that I'm purchasing for the business, but where's my money coming from? Well, let's say that I have $10,000 in capital that's coming from my personal savings, and I take out a $10,000 small business loan, and so that's a liability. My first financial statement is what we call the balance sheet. And the balance sheet basically shows us that we can account for all of our assets, all of our liabilities, and all of our capital. And so the equation for the balance sheet is what we call the accounting equation, which is assets are equal to your liabilities and your owner's equity. So I have all of my assets listed on one side, I have all of my liabilities and owner's equity listed on the opposite side, and each side should total the same, in this case $20,000. So I've got $20,000 in loan and capital, and I've got my clown car, I've got my clown suit, I've got my laptop, and then everything else that I have left over is cash. So the way that I get that cash figure is I take this $20,000 over here, I take this $20,000, and I subtract $7,500, $2,500, $1,500, and I wind up with $8,500, which is my cash balance. So where does everything else go? Expenses and assets that are treated as expenses are what we call realized at the end of the first month of operations. And I'll show you what that means in just a second. Moving on to our next financial statement is the income statement. The income statement is used to measure the profitability of a business over a given period of time. And the idea behind the income statement is it's really designed to answer that question if the entrepreneur gets that how's business question, because with your income statement you can tell if you're making money or if you're losing money. The income statement is calculated as revenues minus expenses. So looking at Christina's Clown College, in our first month we did 3 birthday party performances at $200 each. We enrolled 1 student in our clown class for $1,000 in tuition, and these are our revenues for our first month. So looking at our income statement, just as a couple of formalities here, the title is always the name of the business, the type of the statement, and then for the period that we are accounting for. So this is a 4-month end, which means that we're accounting over a specific period. If you'll notice, I'm going to go back for a minute to the balance sheet. The balance sheet is a specific snapshot in time. So the balance sheet is a specific day. So coming back to this income statement, I have my revenues, which were my performances and my classes. So I had $1,600 in total revenues. And then I've got my expenses, which is my rent, my utilities, my cellular internet service, my startup expenses. So those startup expenses would be all of those expenses and the assets that I decided to treat as expenses, and we're again realizing them, which means we're accounting for them at the end of the month. So I had $4,100 in revenues and I had $4,975 in expenses, which means that I actually had what we refer to as a net loss, which meant I lost money this month. I lost $875. If you're losing money, it is always depicted either with a red number or with parentheses. You don't use the minus sign with accounting. And so if it's in parentheses, we know that that is a loss. The next financial statement, the next 2 financial statements are related. This first one is for individuals who are pursuing a sole proprietorship. The statement of owner's equity basically demonstrates the change in capital for the owner of the business. So we start with the beginning capital from our beginning month of operations. If you'll recall, we had $10,000 of personal savings, and so that's reflected in the first line here. We're adding in our net income. If we put additional capital into the business, we would add that in the statement of owner's equity. If we decided as the entrepreneur to take money out of the business, that would be a draw, and we would subtract that out. The change in all of that is what we refer to as the change in capital. And then our beginning capital minus that change in capital, or add that change in capital, is our ending capital, which for our purposes here is $8,125. If you are a corporation, then you are going to do what's called a statement of retained earnings. And the statement of retained earnings is basically shows the change in equity for the shareholders of the business over a period, over a month-to-month or year-to-year basis. So we start with our retained earnings at the first of the month. That's basically our capital. We add in net income, which here we're adding in our negative $1,875. Any dividends that we would pay out would be subtracted, and then that leaves us with our retained earnings at the end of the month, which is $8,125. Again, for the statement of owner's equity or the statement of retained earnings, you do one or the other, not both. Our next financial statement is what's called our statement of cash flows. And so this is our statement of cash flows for the year end. And our statement of cash flows basically shows how money flows through the business. We have cash from operating activities, investing activities, and financing activities. So we start with cash flows from operations. So we may have cash flows that we collect, cash that we collect from customers in terms of sales. And then we have cash that might get paid out to our suppliers and employees for expenses. And then we also calculate our cash that we're paying out for taxes. That gives us our net cash flow from operating activities right here. Next, go to our investing activities. And for most of us, our investing activities are probably going to be payment for purchasing equipment. So we've got $900 that we paid to purchase equipment. That was our total of investing activities. And then financing activities, let's say over the year we paid out $5,000 in dividends. So there's our financing activities. We add those numbers together, 8,025 minus 900 minus 5,000, and we have our net increase or decrease in cash. We add to that number our cash at the beginning of the year, which was that $10,000. And so at the end of the year, we have $12,125. Remember, going back, it all starts with the balance sheet. At the end of the year, we might do another balance sheet. But just as a reminder, so that balance sheet is that snapshot in time. Just as a reminder, remember that we have our assets on the left, liabilities and owner's equity on the right, and our total assets should equal our total liabilities and owner's equity. So moving on, this is basically the shell of a pro forma financial statement. And basically you've got 12 months across the spreadsheet, and your income and your financial statements just kind of go down the line. So we've got our revenues here. We've got $600 in lessons, $1,000 in performances, and so our total revenues there is $1,600. Our expenses, so we have some rent, some utilities, and our cellular service. Going down, we see that we have $1,900 in total expenses, which gives us a net loss of $375. Remember that we had our $10,000 in capital to start the business, so that starts our retained earnings. We add in our net income, which was negative $375. And so we have $9,625 in retained earnings at the end of the month. Moving on to our statement of cash flows, our operating activities include our cash receipts from customers or our sales. And we might have our operating expenses, so that $1,975. If we had income, we would have our income taxes calculated in. Net cash flow from operations then is $375. We had no investing activities, No financing activities, so we have net cash flow of 0 there. Our net increase or decrease in cash is that $375. Add that to our cash at the beginning of our month, and we have the cash at the end of the month. That's basically how you complete a pro forma statement. I have for you here a completed pro forma statement where I have forecasted out 12 months worth of operations. This will be available for you in Canvas. So all you'll have to do is plug in your numbers over mine. I'll also have a blank available for you. And so here you can see I've got my sales. This is a merchandising business, so I've got inventory that I'm factoring in, my employee wages that I'm factoring in, rent, utilities, cellular service, and periodically I am spending some money on some marketing. Gives me total expenses, and then I can see $6,500 minus that $4,325 gives me a net income of $2,175. My retained earnings at the beginning of the period, you can see moving through, it looks like I did not take any dividends. That's okay. Generally don't want to do that in the first year anyways. Moving on to my statement of cash flows, I've got my cash receipts from customers. I've got my operating expenses. Here I've split out wages. So my operating expenses here includes my my $4,325 less my wages. Wages are called out in a separate line. My income tax is probably going to be my net income multiplied by 22%. Which gives me net cash flow from operations of $1,697. No investing activities, no financing activities, and so my net decrease in cash at the beginning of the month, or net increase in cash, and so I end my first month with $11,697. And if you notice, there's my cash position. And so as you notice going across, you can see that we can very clearly tell and why my cash position at the end of the month look different than my retained earnings. Well, my retained earnings hasn't taken into account the money that I'm going to be spending on taxes. So, you know, and there might be some additional expenses as we go through as you continue your operations. Well, you're going to have interest that you're accounting for in your cash flow statement that you're not necessarily going to see in other parts of your financial statements. So the cash flow statement is really kind of an accurate picture of what's going on with the cash within your business. And so taking a look in Canvas, when we look at your accounting basics module, you'll see that for your financial plan, what I'm going to be looking for is a listing of your startup costs, your opening day balance sheet, a sales forecast, which you'll see in a separate video, and 12 months pro forma financials for your income statement, your statement of owner's equity or retained earnings, and your statement of cash flows. I have posted a sample plan for you that includes, so your forecast, startup, and balance sheet is in a doc here, and then your pro forma statements, your 12 months pro forma statements are right here. You could click on those and you should be able to see those and download them. So that's it for now. Hopefully you've got a pretty good understanding of what I'm looking for with respect to a financial plan. If you have any questions or concerns or need help, feel free to reach out to me. That's what I'm here for, and it's what I love to do.